Hey everyone, and welcome to This Explainer. If you've just signed on the dotted line for your very first house, you're probably feeling a crazy mix of incredible excitement and, let's be totally honest here, a little bit of sheer terror about that 30-year commitment.
I'll be dead before I can pay this house off!
Well, today you can put those worries aside. We're looking past the theory and we are going to focus purely on the math. I promise to show you exactly how to shave years off your 30-year mortgage using real numbers, and we're going to do it without completely destroying your monthly budget. Okay, let's dive into this. Here is our syllabus for the explainer today. We'll start with the true baseline cost. Then we'll be busting the HELOC myth. And after that, we'll go through 4 sequential strategies. Strategy 1 is biweekly payments, then mortgage insurance, canceling escrow, and finally, a no-cost refinance. The magic here is how these strategies will stack together sequentially to create some massive savings. Section 1. The true baseline cost. Facing the 30-year trap. Look, I completely get it. Signing those initial mortgage documents is an overwhelming feeling.
You're supposed to sign them, Jimmy, not eat them.
Take a breath. $541,646. I know, it's a terrifying number. But that is just the interest paid over 30 years on a $380,000 loan. It is absolutely staggering. But don't panic, because this is the exact baseline number we are going to attack today. Let's walk through every single fine detail of where that massive interest number actually comes from. Let's say you bought a $400,000 home in Texas back in October 2023, when rates were sitting at around 7.125%. You put 5% down, which leaves a loan amount of $380,000. Now your monthly P&I, that's principal and interest, is $2,560. Add in $80 for mortgage insurance, $660 for property taxes, because Texas has high property taxes, right? And $400 for homeowners insurance. Your total monthly payment hits exactly $3,700. Over 30 years, that math guarantees you will pay that $500,000 interest figure we just talked about. Moving right along to Section 2, busting the HELOC myth. Don't set yourself backward. Now, before we build our master plan, we absolutely must address the most common, frankly misleading advice first-time buyers find online. If you've ever searched this topic, someone has probably told you to convert your mortgage into a home equity line of credit, or HELOC. Here is why that usually doesn't work. The idea is that a HELOC forces you to pay any leftover income toward your principal by operating your budget right out of the HELOC itself. But the massive flaw here, and this brilliantly illustrates the problem, is that HELOCs usually carry a higher interest rate than your standard fixed mortgage. When you increase your interest rate, you inherently set yourself backward. You could get the exact same benefit by just zeroing out your budget in a checking account and putting the extra money toward your standard mortgage. Section 3. Strategy 1. Biweekly payments. This is the foundation of progressive stacking. With that myth officially busted, let's shift back to the real numbers. This foundational strategy involves switching from planning monthly to planning your money every single paycheck. If you get paid biweekly, you simply set aside half of your mortgage payment each payday. Because there are 26 pay periods in a year, having that gives you 13, meaning you magically create one extra full mortgage payment per year without really feeling the pinch. To make this super easy to visualize mathematically, we'll simulate it by sprinkling that one extra payment across 12 months, which simply adds $213.33 to your monthly payment. Now, what's really interesting about this amortization curve is how slow it starts. From year 1 at $373,592 all the way through year 8 at $313,396, the balance barely moves. That is amortization at work. Amortization. Your early payments are mostly just eating up interest. But look at the back half. By year 16, you drop to $195,820, and by year 20, you're knocking off 25 to 30 grand a year. This proves exactly why every single dollar you throw at this mortgage early on matters so much more than it feels like it does in the moment. Check this out. By simply making this one budget tweak to pay bi-weekly, you save $134,646 in interest, and you pay off the home in 23.6 years instead of 30. That is 6.4 years completely shaved off your mortgage just by implementing Strategy 1 alone. Section 4. Strategy 2. Mortgage insurance. Rerouting the $80. The absolute beauty of progressive stacking is that implementing Strategy 1 triggers Strategy 2 so much faster. Let's look at the domino effect here. First-time buyers usually have to pay mortgage insurance until they hit 22% equity. which on this loan is a balance of $312,000. On the original 30-year timeline, you wouldn't hit that until payment 142. That's almost 12 long years. But because of our biweekly strategy, we get to that equity mark by payment 98, right around year 8. Our action step here is to take that newly freed up $80 a month and seamlessly route it directly to our principal. You are already spending it anyway, so your budget doesn't feel a thing. Applying that extra $80 starting at payment 98 on an exact balance of $311,565 is incredibly powerful. It lowers your remaining months from 186 down to 177. That saves another 9 months of payments and a cool $11,483 in total interest, just for rerouting money you already had. Section 5. Strategy 3. Cancel escrow. Earning your own interest. Now we introduce the third stack. Once you hit that 22% equity mark, you are in a great position to request a cancellation of your escrow account.
Escrow. What's an escrow?
That means instead of the bank holding your money to pay your property taxes and homeowners insurance, you hold it and pay them yourself. Why do this? Well, because when the bank holds your escrow, you earn exactly 0 interest on that money. If you take that $1,060 a month for taxes and insurance and put it into your own flexible CD or investment account at a conservative 3% return, you'll end up earning $208.61 in interest annually. Divided out, it gives you an average of $17.38 of free money every single month to apply directly to your principal. Now, admittedly, this is the least effective strategy on our list, but remember, every single dollar counts when we are fighting compound interest.
I find it so interesting when you talk about interest.
That little $17 a month brings our remaining months down to $175, drops your remaining interest to $189,929, and saves another 2 full months of payments and $2,266 in total interest. Section 6. Strategy 4. No-cost refinance. Seizing the 15-year window. We are moving to the final and most powerful strategy. Around year 8, you'll only have about 15 years left on this timeline, which is the perfect time to refinance into a 15-year term. But I have a very crucial warning for you first-time buyers. So the crucial point is, if your goal is to pay off your loan faster, you must ask for no-cost refinance options. Making your mortgage balance go up is the exact opposite of what we're trying to do here. You must never, ever roll high closing costs into your loan balance. Making your mortgage balance go up entirely defeats the purpose of everything we've done so far. No-cost options allow you to secure a lower rate without taking a single step backward. 15-year rates are typically about 0.5% or more lower than 30-year rates. Let's be very conservative and say you drop from your starting rate down to just 6.625% on a 15-year term. The absolute secret here is that you keep making the exact same monthly payment you've been making all along. That tiny rate drop, combined with the 15-year term and your continued aggressive payments, leaves you with just 166 months and $165,219 in interest remaining. You literally just saved an additional 9 months and over $24,000 in a single move. Let's move to a quick recap and see how this all builds into our ultimate master plan. Step 1. Budget and pay biweekly rather than monthly. Step 2, cut your mortgage insurance at 22% equity and route that difference straight to the principal. Step 3, cut escrow, invest that money, and apply the interest earnings directly to the mortgage. And finally, Step 4, do a no-cost refinance around year 8 to a 15-year term at a rate just 0.5% lower. When you stack these 4 completely realistic, math-based strategies together, the results are just absolutely victorious. As a first-time homebuyer, you save a massive $173,105 in total interest. Better yet, you shave 96 months. That is a full 8 years off your mortgage.
What do we do with all of this money?
And honestly, the best part? You did all of this with virtually 0 painful impacts to your day-to-day budget. We made 3 very conservative assumptions to get these numbers. We assumed rates stay about the same. We assumed your home absolutely never appreciates in value, which is highly unlikely, right? And we assumed you only get a basic 3% return on your escrow investments. If your home actually appreciates, or if rates drop further, your timeline shrinks even more, and your savings grow even larger.
To accelerate this even further, a great bonus tip is to just throw any unexpected cash you might get, raises, bonuses, tax refunds, straight at the principal. Every little bit counts in those early years. If you want to see exactly how these numbers look for your specific situation, jump over to the calculator at noobhomebuyer.com/faster to plug in your own amounts.
This is the greatest calculator in the world!
We've looked at the math, we've built the stack, and we've mapped out exactly how you can beat the system. By taking control right now, you are literally buying back almost a decade of your life. So I leave you with this thought. What will you do with an extra 8 years of financial freedom?
We're home!